Welcome to MHN Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today, we'll be discussing the outlook for the multifamily investment market for the rest of the year and beyond. I'm sure you'll hear some interesting insights. I'm Suzann Silverman, Editorial Director of Multi-Housing News, and joining me today are Mike Cale, Senior Vice President of Capital Markets at Berkadia, Kelli Carhart, President and Head of Multifamily Capital Markets at CBRE, Paul Fiorilla, Associate Director at Yardi Matrix, Sharon Wilson-Geno, President at NMHC, and Justin Levitt, Managing Director and Head of the Northeast Region for U.S. Debt at PGIM. We're recording this session, and it'll be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, so please submit them at any time during the webinar. Don't be shy. And thank you to those of you who submitted some in advance. We'll try to get to as many as possible. Paul Fiorella is going to start us off with an overview, and then we'll begin our discussion. Paul, I'll hand things over to you.
Okay. Thanks, Sue. It's great to be here. And yeah, we're going to do the multifamily outlook. Big picture, multifamily has been rather slow for a few years when we look at performance. So we had a very large run up in rents, about 24% over 2 years coming out of the pandemic. But since 2023, rent growth has been very slow. We just got our 6-month numbers. So through the first half of the year, multifamily rent growth was 1%, 1.0%. Occupancy, the national occupancy rate has decreased 60 basis points over the last 12 months, and it's now at 94.1%. So that indicates kind of a slowness. But of course, nationally, what really matters is regional. So over the last few years, the rent growth has been fairly consistent in the Northeast and the Midwest. And over the last year or so, in the primary markets, San Francisco, Chicago, and New York, over the last 12 months have been the top rent growth markets in the country. Demand is still strong there, and they don't have a lot of supply. Meanwhile, the high growth markets in the Sun Belt and the Mountain West have struggled on a rent growth basis. They still are the top markets when it comes to absorption and demand, but because they've had a very high supply growth over the last few years, rent growth has turned negative, or new asking rent growth has turned negative. So one way we can measure that is by looking at the number of properties in the lease-up phase. So these are properties that have been completed but haven't yet stabilized. And you can see over between 2020 and 2024, 25, the number of properties that are in that phase just about doubled. It's gone down a little bit over the last year, but it's still, close to 1.2 million units nationally in lease-up. And this is not like evenly spread out across the country. The markets that have the high supply growth is where there's this high number of lease-ups. And what that means is that tenants have a lot of choices, and apartment owners have to compete for tenants. We're seeing increased number of concessions in some of those markets. And we're also seeing like the trade out data. These are the change in rents from properties that are vacant and get released. You can see in a lot of markets they're negative, and -4, -6%. So when we're looking at, I get asked all the time, hey, when are rents going to start increasing again in the Sun Belt? And I look at data like this and I think, it's still going to take a little bit of time. The good news is that renewal trade outs are still good. So properties are still getting increases in income from renewals, renewing leases. The average national rate is about 2.5%. So that's good. But there is some weakness. Now, the narrative at the beginning of the year in the multifamily market is, well, starts have gone down. We had a record high, or decades long cycle high number of starts in 2022, about 700,000. That's gone down by about a third last year. So the number of deliveries will also go down. The question is, will it go down enough relative to the amount of demand for rent growth to return to kind of normal levels again? And once again, that's a regional, a market level, submarket level phenomenon. So when we look at the markets that have had a lot of supply, so Austin, for example, had like 25% to its multifamily stock since the beginning of 2023. Um, the percentage of the new supply as a percentage of stock is slowing down. It's moderating. Places, you look at, Miami, Phoenix, Charlotte, Nashville, to, roughly 3-4%, and it's been like 6-7% in the last few years. So that's good. Again, the question is that enough to absorb some of that excess stock that's created the logjam in rent growth? Multifamily absorption was really strong for several years. The beginning, sort of the middle of last year, the absorption rate slowed down a bit. It's still positive, but it's not like record high levels like we've had in some of the last few years. So another issue is, what is the delivery pipeline? And part of that narrative, kind of the optimistic narrative, is that completions are going to go down to like the 300,000, somewhere in that range. And, this is our forecast. So last year, we still had, almost 650,000 deliveries. This year, we're forecasting 478,000. And then kind of the floor over the next few years is somewhere about 450,000. Now, part of the reason that our forecast is higher than some of the other forecasts is that we're also counting affordable senior and SFR BTR in our forecast. But those are units that the market rate apartments have to compete with. So, that I think is justifiably part of the forecast. And, that will be something that we'll see whether, um, the absorption will be enough to meet, the amount of new supply. So our forecast over the next couple of years is that rent growth will continue to be weak, somewhat of a slog through the end of next year. I think it'll take, at least 4 to 6 quarters before that excess stock gets delivered, and then we can start to get back to more normal multifamily rent growth, closer to the long-term historical average, beginning in 2028. And again, when you look at it on a market level, it's very heavily, geared, concentrated in those same Midwest, Northeast markets that don't have a ton of supply, and the Sun Belt, Mountain West markets still gonna take a couple of years before they move into positive territory.
Thank you, Paul.
So,
So let's talk. Kelli, and I'll start with you. Under the circumstances that Paul just outlined, along with the continuation of higher for longer interest rates, what opportunities do you anticipate for NOI growth in the second half, and what happens with property valuations as a result?
You know, I think there's a lot of blocking and tackling going on at the property level to maximize NOI, because we're certainly not getting it at the rental growth, right? So, insurances come in, taxes are, an never-ending battle. But I think some of the G&A has come in well with the payroll. So there's some, downward pressure there to kind of, help. But as far as transactional activity, I mean, people need to understand where rents are going to underwrite transactions and to transact. So that's really been holding back some of the momentum in the multifamily investment sales world, just given the uncertainty of the trajectory of rents, right? If the rent rolls are rolling backwards, it's hard to pin where your year one, year two, through year five is going to be.
Okay, and Mike, how is that likely to impact the pace and volume of transactions in your opinion?
Well, I think that first, we should all put in perspective and kind of get our arms around what happened in kind of 2000, call it 18 to 22, 19 to 22, just was not normal, right? You had very, very low interest rates. SOFR was very low. And then you had, as Paul was mentioning earlier about some of the Sun Belt states, I mean, you had double-digit growth in terms of rent in a lot of these markets. So that obviously fueled a ton of transactions. It allowed a lot of bar sponsors to take place in the market. So we've all kind of been suffering from that the last few years, given where folks' capital stacks are, given what Kelli just mentioned with operations at the asset level. And so obviously sales have been relatively muted over the last few years. I think that this year is probably going to end up being pretty similar to last year, and I'm sure we'll touch on that as we move through this panel. But we kind of started off the year feeling really good, pretty hopeful in terms of transactions, both on the sales side as well as the debt markets. And we've seen a little bit of a lull, if you will, the last kind of 60 days. We all know what's going on in the Middle East. That's played a big part of it. And then just really the loans that are trading, or excuse me, the assets that are trading are really assets that need to sell, right? No, there's very few people just going out there saying, well, it's a good time to sell, let's go do it. So I think you're just gonna see a lot of that continue for the balance of this year, and potentially into the first part of next year as we start to figure out some of the supply and operation side of the equation.
And Kelli, what do you think it's going to take to increase confidence in the multifamily market?
Yeah, I mean, I think, look, we've had a major event every year. It happens to fall in the spring. We have momentum on pipeline and kind of line of sight, and then we have something that sets us back, right? This year it was a major geopolitical event that had an oil shock and interest rates ran. And so really, if we're at like a 4% 10-year, we see a lot of transactional volume. 4.5 is kind of where we see it drop down significantly. So it feels like we're probably going to be in this, range for an extended period of time. So I suspect that, the trajectory will kind of be, as Mike indicated, similar to last year. I think if we get a rally, we'll see a lot more activity. And that happened in the third quarter of last year, which made for a really strong first quarter pipeline. So that's one indicator. And then honestly, if we have some rent growth, right, we're going to be off to the races. So it's two factors. I'm not quite sure either of those will happen in the near term.
Anybody have anything else to add? Well, Sharon, let's talk about some of the recent policies that have been taking place or have gone through. The road to housing is the big one, right? That came through most recently. Do you anticipate it having any impact on the investment market in the near term?
Well, thanks for having me, Suzann, and thanks for the question. The long-awaited 21st Century Road to Housing bill finally became law on Friday. And I think conventional wisdom is there are a lot of small things in this bill that could be helpful right now to a deal here, a deal there. Some of those things have to be fully implemented. I think the headliner from our perspective and where we spend a lot of our time and money and effort was around these potentially really problematic provisions that would have halted build-to-rent housing and the investment market there. We were able to, with a lot of work, get ourselves back to having a normal BTR market and removing those restrictions. There's still some interpretive work that needs to be done. I think when we're working with Treasury on that already, I think once the Treasury puts something in writing that clarifies or just confirms what we all know was the intent, I think you'll see investment in build-to-rent continue and maybe even accelerate because we've now vetted all this and there should be really more certainty in that market moving forward, frankly, given the fact that we've vetted the fact that this is a really important part of the housing market and needs to continue to grow. There's no magic silver bullet here that's just going to open the floodgates and make housing less expensive to construct or less expensive to operate. The most important thing from my perspective is that it is the first major piece of housing legislation we've had at the federal level in 30 years. And we've now demonstrated to politicians on both sides of the aisle in both houses of Congress that housing is one of the most important issues on the minds of their constituents, and they want action. So I was already with a group of congressmen yesterday, and they're already on to what's next. We need to do something. We know this is just a down payment. We need to do something more impactful. What are the things we need to do? And so I think you'll see much more bold proposals and more bold incentives in the coming Congress that may actually include some actual dollars and more robust incentives that could be the things that open the gates. But as all things in Washington, change is incremental, and you have to take a first step. So I think this is a good first step.
It's great, though, that you've gotten such enthusiastic interest in continuing on from there. So it's got to start somewhere, right? Everything does take a while to get through, but
exactly.
What about other policy issues? How do you see the current policy landscape otherwise impacting the multifamily investment market? And what issues are you most focused on right now?
Yeah, we're spending a lot of time, now that the road to housing has made its way over the finish line, we'll be spending some time on the implementation of that. But a lot of the things we're hitting on are all the things, Kelli and others have been talking about. The regulatory environment that's putting pressure on operating costs. Proposals around fee transparency, on limitations on fees. We're seeing limitations on RUBS in certain locations. We're seeing limitations on other kinds of fee transactions. So that's going to put pressure on an already pressurized operating environment that includes a lot of non-controllables, increases in state level taxes, increases in insurance, and alike. So we're spending a lot of time sort of in hand-to-hand combat on those issues, and they're happening both at the federal level, but they're also happening in states and localities where they're being discussed differently in different ways. So we're really playing three-dimensional chess on that right now. The other issue we're spending a lot of time on now is rent control and rent regulation. And you're seeing it in communities across the country. We formed something about 2 years ago, and Yardi Matrix was an inaugural sponsor of and made a really important financial investment called the Housing Solutions Coalition. And HSC is a partnership with ourselves, the mortgage bankers, the National Apartment Association, the home builders, and the realtors to start educating people and politicians at the state and local level about the fact that rent control and rent stabilization policies don't work. It's been demonstrated for decades, and how to point them to solutions that are working and innovations that are happening in other parts of the country. We're tracking in 191 communities across the country last year, where some element of rent control, rent stabilization, or sort of a backdoor way to get at that were being discussed. We were largely successful in pushing back for many reasons in various places, most notably in Massachusetts, where there was a statewide referendum. But this issue is not going away, and it's going to come back with vengeance. And so we're really focused on bringing more investors to match the great investment you guys, maybe Yardi and others, to work together to have the resources we need to push back on these policies that we know don't work, that are well-funded opposition groups are promoting.
Okay, thank you. Justin, how do you weigh the influence of policy and geopolitical concerns versus the more standard real estate capital markets issues on the multifamily markets?
Well, thank you, Suzann, and great question. I think for this one, I'll probably focus on capital markets and then weave in those other items. So I say capital markets liquidity is in a really good place right now. I mean, there's lots of liquidity from all different types of financial institutions, whether that's life companies, banks, the agencies, debt funds. It's very, very liquid market on the debt side. So back leverage is about as robust as I recall, allowing the debt funds to really price tighter, increase volume. As I mentioned about the agencies, what I'm hearing from investors and borrowers is kind of the geopolitical concerns are real, right? And dampening really their ability to push for more acquisitions right now, just given all of the uncertainty. So we're going to have to really monitor that. All the headlines are certainly not helping. We need stability in our business. That's how we all move forward. But that said, I think from our pipelines, we are seeing more acquisition financing requests than we did, say, a couple months ago. Now, given some of the interest rate volatility, which is always the biggest wild card, we'll see how long that kind of remains. Because as we all know, multifamily is driven largely by kind of the treasury volatility. As far as regulatory issues, Sharon did a really good job just now summarizing, all of what we're seeing. I think regulatory issues for me, whenever I get them on a panel and the moderator says, "What's the biggest risk to the industry?" I always say regulatory issues, right? I think biggest concern because it brings volatility and it's out of our control, right? There's so much political uncertainty right now in some of the major cities that we just don't know how to react to some of that, right? So those two items, geopolitical and regulatory, are really the major concerns these days. But the capital markets, I would say, remain, very strong right now. And I don't really see that changing unless some large kind of macro event really occurs. I mean, even when you go back to the tariff announcements last April and the start of the Middle East tensions, this year, the capital markets moved briefly, but really settled very quickly back, right? And I think it's going to take some really big macro event for that to really change, just given the amount of liquidity that's out there.
So, Paul, where's investment capital currently going? Do you see equity players pursuing more debt opportunities or continuing to sit on the sidelines waiting for a better investment marketplace? Where's the capital going?
Yeah, like Justin was just saying, there's a lot of investor capital, and that's the good news that multifamily, when you look at multifamily relative to other property types, it's stable, it's got long-term, stable rent growth, and performance has been relatively stable compared to look at office. What happened in office, retail went through its crisis, and it's kind of it's okay, but it's, nobody's expecting like a lot of growth in retail. And industrial went through a really strong period of rent growth, and now we're kind of decelerating off of that. So, that leaves like multifamily as of the major property types. The investors look at that as the safest type of commercial real estate product. So you do have a lot of investment capital. And because the transaction market has been slow, for the last few years, I think the deal flow, you have a concentration sort of at the high end of the market, cash buyers and, REITs and, companies that are paying, top dollar for high quality properties. And then you have a lot of value add acquisitions, and, there's fewer deals in the middle, and, the brokers on the call could, did talk about that better than I can. But, when I look at the data, there was actually an increase in deal flow at the beginning of the year. And then about the time of the war, it kind of slowed down a bit. So we'll see whether investors have a little bit more confidence in the market going forward. But because, you have a lot of private equity sources now that are looking for high yield returns, and that because there's not enough to buy on the equity side, that has a lot of them turning to the debt market. So there are dozens of and maybe even hundreds of private equity sources that are looking at mezzanine and preferred investments. You just saw we've just seen that the CMBS market has created it, the first multifamily only deals since before the global financial crisis, which is, wow, I'm thinking about it, going on close to 20 years now. So, and that happened because there are sort of BPs, junior bond investors, that some of them used to buy junior bonds from Freddie. Freddie changed the way it sold its junior bonds. So that left some of these high yield investors looking for other sources of high yield debt. Some of it's just, because they can't get enough equity. but there are a lot of partnerships between senior lenders and junior lenders that are financing transactions now, for both transactions and refinancing, like extended loans and distressed loans and so on. So that's created, the way the market has evolved has created a lot of demand for high yield debt, and the debt markets are extremely liquid at the moment.
Mike, what's your read? What do you see driving the property deals that have been taking place, and how would you compare the debt versus equity climates
And I
today?
think similar to what Paul had to say. I mean, the debt markets are way better than the equity markets right now. Just in terms of activity, liquidity, options. If you look at the debt markets and what's available for multifamily, I mean, if you start, obviously you have Fannie, you have Freddie. HUD's become a little bit more aggressive and have pushed up some of their timelines in terms of turnarounds. That's become a viable option in some instances. The insurance companies, really, if you take a look at the insurance companies, there's been a lot of change in that space over the last, 5 to 7 years, both from private equity coming in and either buying insurance companies or partnering with them. A lot of the insurance companies that typically did, let's say, over $2 billion a year, many of their allocations historically had been, call it 20, 25% office. And that's not the case any longer for obvious reasons. But having said that, their allocations have either remained the same or gone up. So you've seen a lot of that deployed in or tried to be deployed into the multifamily space or industrial. But and then, kind of as Paul alluded to on the debt fund side, I mean, there's a new debt fund, it seems, every week that comes to market. There's extreme advantageous things that occur there. You have cheap borrowing costs that they're able to get from warehouse facilities, call it 130 to 150 over. They're deploying the capital 100 basis points north of that at the asset level. And we've seen a lot of large, what I would call owners, move into that space as well and create credit platforms. You have the multifamily only product that Paul's mentioned from a securitization standpoint. So there's a lot of activity there. If you look from my perspective, I think that's positive because if you look back at the Great Recession, that was so heavily weighted towards securitized debt. I think there was $240 billion or something. A lot of that was were larger transactions that took place, but it wasn't allocated properly in terms of all the different options out there. So the debt markets are what I would call very healthy, very liquid. Everybody seems to be chasing a lot of the same things, which creates problems for them. Part of the problems for sponsors is where they are relative to their capital stack when they bought the property, when they developed it. Is it over levered? Things of that nature that are there. And then I would say on the equity side, they're just, Kelli alluded to this earlier in terms of property fundamentals and clarity. There's just no clarity right now that people can see from a variety of aspects, whether that's geopolitical, whether that is regulatory, whether it's operational. The only thing that's really clear is the debt that's out there. People are trying to access it if they can right now. So the equity markets always look for some type of clarity and want to see trades. To answer the first part of your question, we have seen some trades. I would say that trades again are need to sell based, whether that's a lender taking an asset back and having to sell it, whether that's a sponsor for whatever reason closing out the fund, maturity that they can't get it extended. Those types of things. And we're starting to see more of that. I would say there's been an uptick of that as recently. So that's really what the bifurcation right now is in the markets.
Anybody have any further thoughts on this or any different thoughts?
I mean,
Okay.
I would add it goes into another question I think we were going to talk about, what's driving some of that debt activity. So I
Yeah.
say, from my perspective, investors really like the debt space now for some of the same reasons that have been talked about. But I would say, returns are really good. Relative value to other investments is really strong. And the downside is also protected. So you can get a kind of low teens or, low double-digit return on a debt fund transaction now. And that's really good compared to maybe what you could get from on an equity deal. We're seeing so much more investor capital being pushed into private credit these days, especially as more banks are pushing to be in the back leverage space, right? I think a lot of the banks are back, but a lot of them are also back in the back leverage space, which is driving a lot of that debt business. As I mentioned before, I think, lenders are really pushing for more yield and are willing to take on more risk to accomplish that, which I think is really helpful in what Mike was just saying about, some of the upside down capital stacks, right? We need to be able to kind of refi those and not just pretend and extend and deal with that, right? So I think that that's helping, that space a lot. It's definitely harder to raise equity, especially on the core side. Once kind of those kind of Odyssey funds, core money comes back to the market, I think you're going to see a lot of improvement in general. But until that happens, I think we're kind of stuck in this little bit of a limbo period. I don't necessarily think it's a real estate fundamentals issue. We're seeing most markets improving or trying to improve. To me, it's more about relative value and alternatives going forward. So that's what I would add to that, Suzann.
Yeah, and Justin, I'll just add to that. I think you hit the nail on the head, so did Mike. But I mean, fundraising was up 35% last year. So there's one positive. It's been super challenging if you're in that space, but all of it's going to higher yielding strategies. So it's value add, it's opportunistic, and it's debt. And as Justin said, there's just an absence in the core space, and those investors really need cash and current income. They went really heavy in development in the last cycle, and they need to recycle some funds in order to redeploy. So, I mean, that's not just a domestic; that's a foreign investor commonality amongst what we're seeing in the investor space. So it's just people are looking for yield, and that's why alternatives are really getting a lot of attention right now. Right, every conversation is about seniors. That wasn't 12 months ago. That didn't exist. Last 6 months, that's really become a trend. And then students always been desirable, but I would say anything with a bit more yield in those two spaces, you can get a lot more. Are where core capital or strategies that need some yield are going.
Do you see that interest in those other niches continuing to grow, or is that more of a short-term thing while we're in this current market situation?
Well, I mean, like everything else will likely compress if you have a lot of investors, and it's a smaller universe of investing. I mean, compared to conventional multifamily, those sectors are they're less than 10%. So, eventually you have to expand into these other strategies. And right now, I mean, there's some markets that you can get, you have growth prospects and you have good yield going in, but there's maybe some political or regulatory aspect within those markets nationally. So I think it's eventually will even out, but I think both Mike and Justin alluded to this. It's a little dislocated on the equity side, whereas the credit side is functioning very fully and giving all investors ultimate optionality.
Yeah, I mean, we are big investors on the debt investors on the senior side, and we've been for many, many years. But this is the year I'd say that seniors is having its moments, right? We've been big originators on the senior side, and spreads to Kelly's point have really compressed from the end of last year until now by tune of tens of basis points, for sure, many tens of basis points. So it's certainly having its moment, but we feel really good about the fundamentals in seniors and the longer term trajectory in seniors, which is why we're kind of plowing more into that space. And I think that will only continue going forward, given all the demographic changes we have in this country.
When you look at some of the big institutional indexes like the PREA fund, the AFOE, or the NCREIF, Odyssey, or even REIT, the niche sectors have like doubled or tripled their share of those indexes over the last couple decades.
Okay, so let's look ahead in the minutes we have left. And just a reminder to the audience, we will be shifting to Q&A in about 10 minutes. So please, if you've got questions, put them in the Q&A panel, and we'll get to as many of those as we can. But to go back to the panel, let's talk some more about the types of debt players that are more active now, and particularly how alternative financing sources are playing a part in that. And Mike, I don't know if you've got some further thoughts on that.
It's a wide variety. I mean, I think that depending on the size of the group, on the credit side, a lot of the larger players, want to be, I would say, $100 million and over in terms of loan size. But there's a huge middle market space as well. And a lot of I would say the biggest maybe phenomenon is duration, right? There is a lack of borrowers who want long-term duration on their assets. Many of the lenders would love, especially in the insurance company space, would love to do 10 years and beyond financing. So it's just very difficult to do. Most of what's getting done is in that 3 to 5 year space for reasons that, folks want to have optionality. They want to have the ability to potentially sell in a better market. You put longer term financing on that, you potentially, lose that ability to do that. Although there are probably many of folks who wish 4 years ago that they did 10-year debt or 15-year debt or whatever the case may be, right? So I think that's really been happening for the last 10 years. Is, used to be real estate was always financed 10 years and beyond for the most part, and durations have come in. Equity players have shortened their duration period in terms of what they look for, their return hurdles, and the debt has kind of followed suit and accommodated a lot of that, and that's what just is available in today's market.
Yeah, I would say as private equity has become more and more part of the real estate business in general, not just equity, but also debt, the shorter duration, kind of closed funds, right? All goes together, right? And I think that's becoming more and more a part of the real estate business, whereas historically there was more maybe families that owned real estate, and I think that's becoming more institutional now and becoming more on the private equity side, which is driving the duration shorter, as Mike was saying.
Yeah, and I would just add to that. I mean, a lot of these folks would like to sell their assets, and they're just not in an environment that optimizes their investment. So they are taking short duration debt in the hopes that we're in a full recovery in the next 2 years. And of course, we've been saying that for the last 2 years, so it's really a 4-year period. But 60% of what we've been doing has been going to a 5-year index. And that's really because, it's the lowest cost of capital. But we are seeing a significant shift to floating rate. And that goes back to the competitiveness of, the debt funds and their cost of capital that they're putting out. And it's really kind of back to 21, 22 levels where we saw 50 to 60% of owners take floating rate versus fixed rate debt. So I think that's also an expectation that short-term rates will ultimately come down. But less agency business because they're choosing to go floating and they're needing a little bit more leverage because they're betting on the future of a rent recovery.
And one other thing
yeah.
I'd add too that's also interesting is a lot of the deals that are getting done in the debt fund space don't necessarily underwrite to an agency takeout on today's metrics, right? So it'll be interesting to see as a lot of this stuff does come due in 2, 3, 4 years. What happens there? Because you're going to need something to happen. It's going to we're going to have rent growth or cap rate compression or something. But a lot of those are getting done with well-heeled sponsors. And people are betting on basis. Maybe they're having to put in cash to refinance, and even though it doesn't meet a refinance test, there's some goodwill there in terms of additional cash going in. So that's another thing that's happening.
Kelli, you made reference earlier to the foreign investors. So let's just talk a little bit more about what they're doing on both the debt and the equity sides. How much have they been impacted by geopolitical issues, and are their strategies differing at all from domestic players currently?
Well, what we've seen from foreign investors is one, they want larger deployments, so bulky transactions, right? They want to deploy and scale, and they need returns. So, like, it's primarily been going to credit because there's a higher return threshold. We are seeing, groups that want to be, the conviction in multifamily is really strong. Groups that want to be in multifamily, but they do need to recycle some capital, and we're seeing some of that happening right now. I would say the Canadian and the Japanese historically have been the most active, and they continue to be the most active in showing up on bid sheets. But I think last year's geopolitical, or I would say the domestic political scene, was a little bit more challenging for a lot of foreign investors. It feels like now it's just kind of the uncertainty of the current situation, and so the deployments may be just a little prolonged, right? Their decision making is prolonged. They want to be in U.S. real estate. It's just they may need a couple more quarters to digest what's happening before they're ready to make that investment. But it's historically less than 5%, right? So I think we talk about foreign capital all the time. Really, it's in mixed managers where it's going out. So think of like the larger multi-managers that have separate many vehicles, different costs of capital versus coming in direct.
Mm-hmm. And Sharon, you
foreign investors that we talked to, and I was just in a meeting with some before I came in here. They're asking increasingly about the regulatory environment in the U.S. Mm-hmm. And I think that's something we have to continue to keep our eye on. They see a whole lot less certainty perhaps than they used to see before, particularly around rent stabilization and rent control issues. So it's something we have to continue to think about as we continue to have how we talk about that with foreign investors, and obviously culturally and business wise different in different places.
Paul, I don't think we've talked about refinancing yet. I know we were talking about the extending loans earlier, but I think we haven't hit on this. How do the prospects for refinancing compare to last year, and what do you anticipate for the second half relative to the first half of this year?
Well, I think, we're going to see, when there was, going back to say 22, right, when interest rates went up, there was a lot of, that created a lot of underwater loans. And there was, a lot of predictions about, another GFC. But it hasn't happened that way. I think the refinancing of some of these underwater assets that are distressed have been taking place kind of slowly. Banks have extended. I think they're going to, and I think there'll be a pickup in the number of those transactions that will get refinanced and restructured. Some of it is because, again, there's a ton of capital looking to do those kind of deals. And on the private equity side, they're very willing to be more creative in structures to try and help to get the deals done. And I think banks getting pressured from regulators to hey, finally get rid of these kind of things. So I think there'll be continued momentum, and banks are willing to finance the private equity to take them off their books. So in some cases, a bank loan will be replaced by a private equity loan, and the private equity loan is being financed, by the bank. So, it's sort of a technical thing that it's off the books, but still regulators are pressuring banks. So I think they'll continue to see more of these things, more of those kind of loans getting refinanced. I still, it's going to be under the radar. It's not going to be like a bank sells $2 billion worth of loans overnight. It'll just be deals getting done sort of on a one-off basis, continue over the next year or so.
Okay, before we go to Q&A, I'd just like to go around the group and ask you, looking ahead, what you see as the biggest issues or concerns to watch out for, as well as bright spots that you see in the market. Let's look at both. Um, and Mike, do you want to go first?
Suzann, you're putting all the pressure on me.
Not
Um,
really, because then everybody else will say, "Oh, what Mike said."
um, Probably not, but I think from a bright spots, it's many of the things that were mentioned on this panel. It's the amount of liquidity that's in there in the debt capital space. It's lenders willing to work with existing clients, although sometimes that creates problems. I think the biggest thing to worry about from my perspective is something that we don't know. I think we always say that, but that really is something that drives the overall market. Um, the CLO market and the financing in that space is so tight and cheap. And as Justin mentioned earlier, when there was a hiccup a couple months back, things moved out a little bit, but not much, and they recovered really quickly. I think we were all expecting it to be a lot worse than it was in the capital markets. So anytime that market is so tightly wound, if you look where triple A's are, they're in the mid to high 70s on CMBS transactions. So the margins are very tight there. And I would just say if there's some kind of event worse than what we saw a couple months ago, then there's the ability for folks to pull back kind of in that space a little bit.
Okay. Sharon? I
Again, I think that there's just sort of this political environment that everybody's got to keep their eye on, and how that frames where investment is going to go. It's deal by deal, and where people think that there is going to be more certainty is where the money's going to go.
Okay, Justin?
I would say the bright spot is liquidity, and I think we've all highlighted that, but I truly believe that that is the biggest positive that we have in the market right now. And the biggest issue, I would say, is again uncertainty around kind of the geopolitical concerns, political concerns, driving real change in our country and around the world. It seems like so many headlines don't really move the markets, but I think eventually we're going to catch up to that, and we'll see what happens at that point. The other thing that I would just quickly mention as a potential issue that we need to start, I think, thinking more and more about is just the national debt in general, right? Like, what is that going to do to our country, to our consumers, to the world in general, right? Just more and more sovereign debt. And I don't think people talk about that because I think that, it's just the unknown. But eventually, I have to believe that it's going to catch up to us and it's going to impact our business and just the market in the world in general.
Okay, Kelli?
Yeah, I think bright spot is conviction for multifamily amongst the investor base, right? Everybody wants to be in it, and the fundamental, support it. Meaning, we're fundamentally undersupplied in housing, the cost of renting versus owning, all those things. I mean, there's just some uncertainty around job growth, right? So that would be my middle category is uncertainty as people think about how do we drive demand for all these apartments, and we're through the supply shock. How do we make sure we get the absorption? And so, AI, all those things, right? That's the uncertain. We have high conviction, uncertainty around how we will absorb these apartments and drive rents. And then the challenge is, I think, Sharon's mentioned many times, just the regulatory environment. Most of our conversations with investors and what they discuss in investment committee is not geopolitical. It is regulatory risk and how do they deploy capital. And they are voting with their capital, as Sharon said, and deploying in lower risk regulatory environments.
Okay, and Paul?
So we haven't talked about prices and cap rates, and just to be a little bit different here, and I'm not a reflexive contrarian, but there's a sense, and I hear this when I'm, going at events around the industry that, hey, prices went down a couple of years ago, 20%, and so now we're going to rebound because if you look at the last 30 years or so, every time there's a downturn, prices spring back up. And I actually saw somebody with a chart like that, looking at 2010 and how prices went up after 2010, and then they were like, okay, so like here we're just at the beginning of that, and it's going to keep going up. And I'm just a little bit more cautious about pricing. And if people are doing deals with the expectation that we're going to bounce back, there's a lot of liquidity. So are we going to price things because there's a lot of competition to win deals? But I mean, I'm thinking that it's going to be a very slow increase in prices because if you look at where interest rates are, mortgage rates, and versus cap rates, especially in multifamily. So multifamily, a lot of properties are still trading 4 or 5%. And the mortgage rate, you're talking at least 5.5% for a fixed rate loan. Some of the floating rate stuff is less than that, but or so. For prices to go up, either cap rates have to go down or capital is going to, the cost of capital has to go down. Now, at the beginning of the year, we were talking about interest rates going down, but that talk has kind of been kind of replaced with, well, how much are rates going to go up? I don't know that they're going to change a lot one way or another, but I think, they're not going to go down below 4% anytime soon, which would create, kind of lower mortgage rates and kind of help cap rates go down. So right now, you still have a very narrow gap between cap rates and interest rates. And they don't always move in tandem, but over time, there's a 250 basis point spread, and we're still less than that right now. So I think over the next few years, price increases are going to be kind of very modest based on properties improving income or cutting expenses or, improving their bottom lines more than just, everything is going to go up because of market conditions, which is, kind of what, as one of the narratives you hear in the market.
All right, thank you. Let's turn now to some questions from the audience. The first one is, although SOFR has been well behaved, long rates are stubbornly high and some would say likely to stay that way. How does the panel see this affecting multifamily transaction values and volumes over the next 12 months? Who wants to take that first?
I think we answered that earlier, just speaking to where we feel like, at least from my perspective, inflection point on transactional volume is, right? So if we hit a 10-year treasury, which is at 4, and that would maybe indicate a weaker economy, which likely would also result in, Fed funds coming down a bit, you'll see transaction volume increase significantly. But I think higher for longer is the reality. There's still going to be transactional flow because every year we have maturities and we have a lot in 27 through 30, which is interesting because that's, agency book. And right now the cap is probably going to be a challenge to hit for them. Right. But if you think in 2 to 3 years, there's going to be quite a bit of expansion and all the short-term debt that's been taken on. So, I think we'll have a steady state of transactional volume that's going to be increasing because of just maturities and those that have fund life expirations that really were heavy, 5 to 7 years ago. But then to really increase that, you need value rebound and or rate help. And I think we've talked through that a couple times throughout many of the speakers here.
I also just think we need stability, right? There's so much volatility in the treasury every day that SOFR's been relatively flat, right? And I think that that's part of your question. There's been so much volatility in the treasury. If it would just remain in a 10 bip band for a longer period of time, I think that would lead to more transaction volume as well, right? I think portfolio managers just don't understand how to price when you have so much volatility, right? So I think if we had more stability, that would really help too.
We've got somebody wondering what credit trends you're seeing in Class C and workforce housing. Anyone?
I think in Class C, it's challenging, I would say. Many of the debt funds that have been raised and are deploying capital, one of the first things they'll tell you is they want preferably 2000 and newer, or maybe 1990. They'll go to older asset classes in very infill locations. To me, that's one of the bigger challenges in the market is the C assets, getting them financed. And then just a lot of the basis that needs to be reset. So again, I think I mentioned this earlier. We're seeing the assets that are typically going and being foreclosed on by lenders and then looking to be sold, in my opinion, are the older assets, and maybe C assets. Um, and a lot of that's driven by the debt capital that's just out there to refinance those.
Yeah, I would just add, Mike, I was using the same word, challenging. And then I would just say flight to quality, right? And, I think there's just further repricing in that space. And so, and uncertainty around probably our immigration policies that are driving some demand there as well, and or challenges. And then there's the physical obsolescence aspect and the capital needs that investors are having a challenge with, and, both on debt and equity.
Okay, Sharon, you were talking earlier about the Road to Housing Act. We've got a question: with stagnant to limited rent growth for the next few years. I know it's going to have the act is going to have a slow impact, but do you see it throwing more supply on a tepid market and setting things back more? Or what kind of risk do you see of
There's
that?
nothing in this bill that's magically going to open the floodgates. So I don't think it's really going to be impactful. Again, my hope and all of our hopes is that it lays a foundation for closing some of those gaps between actual costs and where rents are right now, and providing opportunities for people to either preserve or to reinvest or to build new, that on a more economically advantaged basis.
Okay, got time for one or two more questions. This person says, I've come to believe that higher interest rates were settling as the new normal. With current inflation, there's talk about interest rates potentially going up again before the end of the year. And Paul, I think you were referencing that earlier. How will that impact the momentum we were starting to see?
Yeah, I mean, I think for deal flow to really open up, and people were anticipating at the beginning of the year rates going down to like 4% or less. And we actually did have early in the year, I think it was February, when rates actually did briefly dip below 4, and we started to see deal flow. And then when, the war started and both oil prices went up and it created, other kind of uncertainty about what's going on. We could see our transaction activity kind of slowed down. So at the beginning of the year, we were a little bit ahead of last year, but now we're a little bit behind last year. By the end of the year, probably be, about the same. But definitely, for a lot of deals to pencil, the interest rate in the low 4 would facilitate that, and interest rates, over 4.5, higher than 4.5, kind of, clog up the transaction works.
Okay, well, unfortunately, we are out of time. We will be sending everybody a link when the recording is available. If you enjoyed this webinar, please join us for future MHN Voices webinars, which do take place each quarter. And so we've got another one coming up pretty soon. And if you'd like some insights on the commercial real estate outlook, be sure to check out the CPE Voices webinar series. Thank you to all of our speakers today for your very interesting discussion. I think we heard a lot of great insights and thoughts, and got some outlook for what's to come. And thank you to the audience as well for attending today.